Picture a woman standing in front of a bank of television screens, and every single one of them is flashing the same word in bright red letters: gold, gold, gold. Because in January of 2026, the price of gold did something it had never done before in the entire history of modern markets. It blew past $5,500 an ounce and kept climbing. And for a few dizzying weeks, it felt like the whole world had suddenly remembered that this heavy yellow metal, older than every currency, every stock exchange, and every government now in power, was still the thing people reached for when they stopped trusting everything else. Meet Melissa, a 47-year-old high school teacher and part-time small business owner from Columbus, Ohio, who had spent the last 2 decades quietly building a retirement account the traditional way, contributing to her 403, holding a mix of index funds, and mostly ignoring the noise. But in the spring of 2026, the noise got impossible to ignore. Her coworkers were talking about it in the break room. Her brother-in-law mentioned he had rolled part of his 401k into something called a gold IRA. And every time she opened her phone, there was another headline about record prices, tariffs, inflation, and central banks quietly stockpiling bullion like they knew something the rest of us didn't. She started asking herself the same question millions of people were asking that year. Is it too late to buy gold, or is this actually the beginning of something bigger? So she decided to do what she always did when she didn't understand something. She researched it properly, from the ground up, and what she found surprised her in almost every direction. The first thing Melissa learned was that gold in 2026 wasn't behaving like a quiet, boring safe haven anymore. It was behaving like a headline generator. The metal had surged an almost unbelievable amount over the previous year, smashing through $5,000 an ounce, then $5,500, before pulling back sharply, falling more than 20% from its January peak by the time spring turned into summer, rattled by a short but intense conflict involving Iran, by a stronger than expected US dollar, and by traders taking profits after one of the fastest run-ups in gold's history. That pullback scared some people out of the market entirely, but it didn't scare the people who actually move the biggest amounts of gold on the planet, the world's central banks. Melissa read that central banks bought gold at a pace that stunned even seasoned analysts, with one quarter alone bringing in close to 290 tons, a record for that time of year, even as prices were still historically high. Poland kept adding to its reserves, aiming for a self-set target of roughly 700 tons. China's central bank kept buying too, its largest quarterly purchase in years, pushing its declared holdings past 2,300 tons, though many analysts suspect the real number, including undeclared purchases, is even higher. A survey of central bank reserve managers found that a striking percentage expected to reduce their US dollar holdings over the next 5 years, and a record share said they plan to increase their gold holdings over the next 12 months. Melissa found that detail more convincing than any single price prediction, because these were not day traders chasing a headline. These were institutions with 50-year time horizons, making a structural bet on what money itself was worth. Still, she wasn't naive about the forecasts flying around either. She noticed that even the big banks couldn't agree with each other. Goldman Sachs had one target, JP Morgan had another, sometimes thousands of dollars apart. Wells Fargo raised its outlook twice in a matter of months. HSBC trimmed its own forecast down, and one firm even predicted gold could fall all the way back toward $4,000 by year-end, while another insisted $6,000 was realistic. Reading through all of it, Melissa realized something important. Nobody actually knows exactly where gold is going next. Not the banks, not the analysts, not the guy on financial television with the confident voice, and anyone who tells you they know for certain is selling you something. What she could see clearly, though, was the underlying story: persistent inflation that hadn't fully gone away, ballooning government debt across major economies, ongoing geopolitical tension, and a slow but very real shift away from the US dollar as the only reserve currency that mattered, a trend some analysts were now calling de-dollarization. Those forces don't resolve themselves in a single news cycle, they play out over years, and that context mattered more to her than any single price target. Once she understood the bigger picture, Melissa turned to the practical question. If she wanted actual physical gold, instead of just following headlines, how would she even go about buying it? She learned quickly that gold bars come in an enormous range of sizes, from tiny 1-gram wafers that cost less than a nice dinner out, up through 1-ounce bars, 10-ounce bars, kilogram bars, and all the way up to the massive 400-ounce good delivery bars that central banks and bullion banks trade among themselves, worth well over $1 million each, and never meant for an individual buyer. For someone starting out, she found that almost every guide she read pointed to the same advice. Start small, start with a single 1-ounce bar, or a recognized government-minted coin like an American Gold Eagle, a Canadian Maple Leaf, or a South African Krugerrand, because these products are the most liquid, the most widely recognized, and the easiest to resell later without a headache. She also discovered that the price she would pay was never simply the spot price quoted on financial websites. Dealers add a premium on top of that spot price to cover refining, minting, distribution, insurance, and their own margin, and that premium varies a lot depending on the product. Government-minted coins typically carry a higher premium, sometimes 4 to 8% over spot, because of the recognizable design and legal tender status, while generic bars from major refiners tend to carry a lower premium, often just 1 to 3% over spot on larger sizes, which means more actual gold for the same amount of money, but slightly less brand recognition if she ever needed to sell in a hurry. Purity mattered too. Investment-grade gold bars need to be at least 99.5% pure, and the very best bars, marked 9999 or described as 4 nines fine, are 99.99% pure gold, produced by internationally trusted refiners like the Royal Canadian Mint, the Perth Mint, and Pamp Suisse. Anything below investment-grade purity, she learned, is really meant for jewelry, not for wealth preservation, and serious buyers avoid it. This is also where Melissa hit the part of her research that genuinely unsettled her, the reality of counterfeit gold. She had assumed fraud in this space was rare and old-fashioned, maybe a scam from decades ago involving lead-painted yellow. Instead, she found detailed recent breakdowns of an entirely different level of sophistication: tungsten-filled bars. Tungsten has a density almost identical to gold, close enough that a counterfeit bar drilled out, packed with tungsten, and resealed with a thin layer of real gold can pass a basic weight check and even fool a simple scale or caliper measurement. Some of these fakes have reportedly turned up not just with small-time buyers, but inside the vaults of major banks and even government reserves, which is a genuinely alarming thought. She read that a basic magnet test can catch the crudest fakes. Since real gold is diamagnetic and won't react to a strong magnet, while iron or nickel cores will, but a well-made tungsten core defeats that test completely. Surface-level scanning technology called XRF can identify the composition of the outer layer of a bar, but it only penetrates a few microns deep, meaning it can be fooled by a gold shell that's thick enough to hide what's underneath. The gold standard, so to speak, for catching a well-made tungsten fake is ultrasonic testing, which can see through the entire bar without damaging it. But that's specialized equipment most individual buyers will never own themselves. What this told Melissa was not that she should be paranoid, but that where she buys matters enormously. Reputable, long-established dealers, members of recognized industry associations, registered and licensed appropriately, selling bars with serial numbers and assay certificates from trusted refiners, dramatically reduce this risk because their entire business depends on trust and buyback relationships. Buying from an unknown online seller offering a price that seems too good to be true is exactly how people end up owning an expensive paperweight instead of an appreciating asset. With that lesson learned, Melissa moved on to the next big decision: where to actually keep the gold when she owned it. She compared 3 main options. Keeping it at home in a quality safe gave her instant access and total privacy. No third party knowing what she owned or how much, and no ongoing fees. But it also meant she was solely responsible for security. And homes remain one of the most common targets for burglary. Plus, most standard homeowners' insurance policies. Cap coverage for precious metals at a surprisingly low amount unless she paid for a special rider. A bank-safe deposit box offered a middle ground, relatively cheap, often somewhere between $50 and $200 a year depending on size and location, with solid physical security. But she learned something that genuinely surprised her. The contents of a safe deposit box are not insured by the bank or by the FDIC, so if something ever went wrong, theft, fire, flood, she would likely have no recourse at all, and she'd also be limited to accessing it only during regular banking hours. The third option, professional vault storage through a private depository, offered the highest level of protection, biometric access, armed guards, round-the-clock surveillance, and full insurance coverage through underwriters like Lloyd's of London, with annual fees typically running somewhere between 1/4 and 1.5% of the value of the metal stored. So on $10,000 of gold, that might mean $50 to $150 a year, a manageable cost for real peace of mind. Though it does mean giving up the ability to physically hold the gold whenever she wants. Melissa realized this decision came down to trade-offs: control versus security, privacy versus insurance, convenience versus cost. And there was no universally correct answer, only the right answer for her own comfort level and the size of her holdings. As she got deeper into her research, Melissa also had to confront the fact that physical gold bars weren't the only way to get exposure to this trend, and she owed it to herself to compare the alternatives honestly. Gold exchange-traded funds, or ETFs, let her buy a security on the stock market that tracks the price of gold, often backed by real bullion sitting in a vault somewhere on her behalf. She learned that global gold ETF assets had swelled to enormous size by mid-2026, hundreds of billions of dollars, with daily trading volume in the billions, meaning she could buy or sell instantly during market hours with none of the hassle of shipping, storing, or insuring anything herself, and typically for a small annual expense ratio rather than a large upfront premium. The catch, she found, is that she would never actually hold anything. She would own a claim on gold managed by a financial institution, And during periods of real financial stress, the kind of stress that makes people want gold in the first place, some ETF structures have shown they can face liquidity constraints of their own, as happened with a wave of ETF redemptions in the UK during a market wobble earlier in 2026. There was also the option of gold mining stocks, shares in companies that dig the metal out of the ground, which can rise even faster than gold itself when prices are climbing and the company is running efficiently, but which also carry company-specific risks that have nothing to do with the price of gold at all: bad management decisions, rising operating costs, geopolitical risk in the countries where the mines are located, labor disputes, any of which can tank the stock even while gold itself is doing fine. And then there was a newer option she hadn't even known existed a year earlier: tokenized gold, digital tokens like PAXG or XAUT that are supposedly backed one-to-one by physical gold held in a vault, letting crypto-native investors get exposure to the metal without ever touching a bar or a coin, an interesting bridge between the oldest asset in the world and the newest financial technology. Though she felt cautious about the added layer of counterparty and custody risk that comes with trusting a token issuer rather than a bar in her own hand or a regulated ETF. Speaking of newer technology, Melissa couldn't avoid the conversation everyone kept having in 2026, gold versus Bitcoin, which asset actually deserved the label safe haven. She found this comparison fascinating because the two assets told very different stories that year. When a short, sharp military conflict involving Iran broke out in early 2026, gold jumped more than 5% within 48 hours and then held its gains as central banks kept buying, even while some private investors took profits. Bitcoin, meanwhile, dropped around 12% in that same window and kept sliding, eventually falling more than 30% from its late 2025 highs, trading almost in lockstep with the Nasdaq and the S&P 500, rather than moving independently the way a true safe haven is supposed to during a crisis. Some crypto advocates pushed back, arguing Bitcoin was still maturing as an asset class and that its long-term trajectory as a hedge against currency debasement remained intact. And Melissa found that argument worth taking seriously too, since Bitcoin has behaved differently in different stress scenarios, and the debate is genuinely unsettled among smart people on both sides. But for her own purposes, thinking about capital preservation heading into her 60s rather than aggressive growth, the 2026 evidence leaned pretty clearly toward gold's more stable, more institutionally anchored behavior during actual moments of panic. It was around this point in her research that Melissa's brother-in-law brought up his gold IRA again, and she decided to actually dig into what that meant instead of dismissing it. A gold IRA, she learned, is a self-directed individual retirement account that allows an investor to hold IRS-approved physical precious metals instead of the usual stocks, bonds, and mutual funds, while keeping the same tax advantage status as a traditional or Roth IRA. Interest in rolling a 401k or existing IRA into one of these accounts had genuinely surged through 2026, driven by exactly the same forces she'd been reading about: inflation concerns, market volatility, and a broader questioning of the old-fashioned 60% stocks, 40% bonds portfolio that had dominated retirement planning for decades. She read that some prominent voices on Wall Street had gone as far as suggesting a 20% allocation to gold and silver as a way to build a more resilient portfolio for this era, replacing part of the traditional bond allocation, a notably aggressive shift from the old rules of thumb, which typically suggested keeping precious metals to somewhere between 5 and 15% of a portfolio at most. She learned the mechanics, too, that a rollover has to be handled carefully, through a direct trustee-to-trustee transfer or within a strict 60-day window if done indirectly, that the gold has to meet specific IRS purity standards, that it must be stored in an IRS-approved depository rather than at home, and that ongoing custodian and storage fees are a real cost that erodes returns over time, on top of losing something else entirely, any dividend or interest income, since gold, whether inside an IRA or sitting in a home safe, pays absolutely nothing while you hold it. Its entire return comes from price appreciation alone, which cuts both ways. Wonderful when prices are surging the way they had for the past 2 years. Painful during the long stretches of history when gold went essentially nowhere for a decade or more, while stocks quietly compounded in the background. That single fact, no yield, no dividends, no interest, kept coming up again and again in Melissa's research, and it became the anchor for how she thought about the whole decision. Gold isn't an investment in the traditional sense of generating cash flow or business growth. It's closer to insurance, a hedge against a specific set of risks: currency debasement, runaway inflation, a loss of confidence in financial institutions, geopolitical shock. Insurance is valuable precisely because you hope you never need to cash it in for the reason it was designed for, and you don't want to pay for so much of it that you can't afford anything else. With that framing settled in her mind, Melissa made her decision. She wasn't going to move her entire retirement account into gold, and she wasn't going to chase the headlines predicting $6,000 an ounce by New Year's Eve either. Instead, she decided on a modest, deliberate allocation, something in the range most financial professionals kept coming back to, somewhere around 5 to 10% of her total portfolio, split between a couple of 1-ounce investment-grade bars from a well-known refiner, bought through a dealer with a long track record, verifiable industry membership, and a clear buyback policy, plus a smaller position in a physically backed gold ETF for liquidity, in case she ever needed to rebalance quickly without dealing with a dealer's buy and sell spread. For storage, she chose the middle path too, a small amount at home in a proper safe for peace of mind and immediate access, and the larger portion in a professional, fully insured vault, accepting the modest annual fee as the cost of not losing sleep over it. She made a point of checking every mark stamped into each bar, the refiner's name, the weight, the purity, and the serial number, cross-referencing it against the assay certificate that came with it, and she kept every receipt and document organized in case she ever needed to prove provenance when reselling. Months later, when people asked her about it, Melissa didn't talk about gold like it was a lottery ticket or a guaranteed path to riches, because by then, she understood clearly that it wasn't. She talked about it the way an experienced investor talks about any piece of a diversified portfolio, as one tool among several, chosen for a specific job, protecting purchasing power and providing ballast during the kind of turbulent, uncertain years the 2020s had turned out to be, record debt levels, persistent inflation pressure, geopolitical flashpoints flaring up with unsettling regularity, and central banks around the world quietly voting with their own reserves for a world that trusted the US dollar a little less than it used to. She still held most of her retirement in a diversified mix of stocks and bonds because she understood that gold, over long stretches of history, has often underperformed equities, and that treating it as a replacement for a balanced portfolio rather than a complement to one is one of the most common and costly mistakes new gold investors make. What changed for Melissa wasn't her belief that gold would make her rich. It was her understanding of why people have trusted this particular metal for over 5,000 years, through the collapse of empires, the printing of endless paper currencies, and every financial crisis in between, and her ability to now separate the genuine structural forces behind gold's current moment, real central bank accumulation, real de-dollarization pressure, real inflation concerns, from the noisy, ever-shifting short-term price predictions that dominate the headlines, but that not even the biggest banks in the world can consistently get right. Before she finalized anything, Melissa also spent time reading about the everyday demand side of the gold market, because she wanted to understand who else was buying and why, beyond central banks and Wall Street analysts. She learned that ordinary bar and coin demand from individual investors had itself surged to one of the highest levels ever recorded in early 2026, jumping sharply year over year, and that this retail buying wave was happening alongside, not instead of, the institutional buying she'd already read about, meaning the demand for physical gold was coming from almost every direction at once. Governments, funds, and regular households, all reaching for the same asset during the same stretch of uncertainty. She noticed a geographic pattern too, that a huge share of global gold demand continued flowing from west to east, with strong buying out of China, India, and other Asian markets, partly for investment and partly for the deep cultural tradition of gold as savings and as a store of family wealth passed down through generations, a tradition that predates modern banking by thousands of years. At the same time, she read that Western investors had been more inconsistent, at points even net sellers of gold ETFs when prices spiked, taking profits, only for Eastern demand to more than absorb the difference, which told her that the story of who actually wants gold in 2026 is genuinely global, not a single country or a single type of investor driving the trend. Melissa also wanted to understand the tariff and trade angle that kept popping up in her feed, since she kept seeing headlines connecting gold's rally to trade tensions and tariff threats between major economies. She read that whenever tariff rhetoric escalated, particularly around trade with major partners, gold tended to catch a bid as investors worried about slower global growth, disrupted supply chains, and retaliatory measures rattling currency markets, while assets seen as more directly tied to global trade and growth expectations wobbled. It made sense to her once she thought it through. Tariffs create uncertainty. Uncertainty makes people nervous about paper promises, and gold has always been the asset people turn to specifically because it isn't anybody's promise. It doesn't depend on a company staying solvent or a government honoring a bond. Its value exists independently of any single institution's word. That independence, she realized, is really the thread connecting almost everything she'd learned. The reason central banks are diversifying away from dollar-heavy reserves. The reason individual households in unstable currency environments have relied on gold for generations. And the reason even skeptical conservative investors like herself were suddenly willing to carve out a small slice of a lifetime retirement account for a metal that generates no income at all. Melissa also spent real time comparing dealers before she ever placed an order. Because she'd read enough horror stories by that point to take it seriously, she built a simple checklist for herself, confirm how long the company has actually been in business, ideally a decade or more, check its rating with organizations like the Better Business Bureau, Along with a broad base of independent customer reviews, rather than a handful of suspiciously glowing ones, look for membership in recognized industry bodies that require ethics codes and audits, verify the dealer is properly registered with relevant regulators, and make sure pricing is fully transparent, with the premium over spot clearly disclosed rather than buried, along with a clearly stated buyback policy, so she'd know exactly what to expect if she ever wanted to sell the metal back down the road. She also learned to be wary of high-pressure sales tactics, the kind where a salesperson pushes urgency, claims a price is about to jump dramatically, or steers a first-time buyer toward rare or numismatic coins with enormous markups instead of simple, low-premium bullion, since those collectible-style products are priced on rarity and demand among collectors, rather than on the gold content itself, and they're notoriously difficult for a beginner to resell at a fair price. On the authentication side, she picked up a few simple habits any beginner could use even without expensive lab equipment, weighing a bar precisely on a certified digital scale and comparing it against the refiner's published specifications down to the hundredth of a gram, since a tungsten-filled fake of the same outward dimensions will typically come in just slightly underweight, running a strong rare earth magnet near the piece without touching it, since genuine gold is diamagnetic and will not be attracted while a base metal core like iron or nickel will pull noticeably, and, for larger or higher value purchases, simply paying a small fee to have a professional appraiser run an XRF scan, or better yet, an ultrasonic test, since that upfront cost is trivial compared to the risk of unknowingly holding a worthless tungsten core for years. She also made peace with an uncomfortable truth she read repeatedly in her research, that even trained experts in major financial institutions have been fooled by the best-made counterfeits in the past, which is exactly why buying exclusively from dealers with strong reputations and documented chains of custody matters so much more than any home test she could perform herself. Looking back on everything she'd learned, Melissa found it helpful to think about the whole decision in terms of a few honest questions, rather than a single yes or no verdict. Questions like how much of her portfolio she genuinely needed protected from a scenario where inflation stayed stubbornly high or the dollar weakened meaningfully, how comfortable she actually was giving up any yield on that portion of her savings. In exchange for that protection, how much hassle and cost she was willing to accept around storage and insurance, and how quickly she might realistically need to access that money if an emergency came up. Answering those questions honestly, rather than simply reacting to a chart going up or friends' excitement at a dinner party, was what finally gave her the confidence to move forward with a plan that actually fit her life instead of someone else's headline. If you're asking yourself the same question Melissa asked in the spring of 2026, whether buying a gold bar makes sense for you, the honest answer is that it depends entirely on your own goals, your time horizon, and how much of your financial plan is already built on a solid, diversified foundation. Gold can be a genuinely useful way to protect purchasing power and add resilience to a portfolio during uncertain times, but it pays no yield. It can be volatile in the short term, even within its long-term uptrend. It requires real diligence around dealer selection, authentication, and storage to avoid becoming a victim of increasingly sophisticated fraud. And it works best as one carefully sized piece of a broader strategy rather than as a single bet on where the next headline takes the price. The people buying gold responsibly right now aren't the ones chasing the $6,000 prediction because it sounds exciting. They're the ones who took the time to understand premiums, purity, storage trade-offs, and their own risk tolerance before they ever handed over a single dollar. And that, more than any price target from any bank, is what actually separates an informed investor from someone simply reacting to the news. There's also a quieter, more personal lesson buried inside Melissa's story that's easy to miss amid all the numbers, tonnage figures, and forecast tables, which is that the process of slowing down and actually understanding an asset before buying it is itself a kind of protection, maybe the most important one of all. It's tempting when prices are surging and every headline seems to shout the same excited message, to treat an investment decision like a race, to feel like waiting even a few weeks means missing out forever. But the investors who tend to regret their gold purchases the most, according to nearly every dealer and financial advisor Melissa read from, aren't the ones who bought a little later than they wanted to. They're the ones who bought in a panic, overpaid a steep premium to a pushy salesperson, skipped basic authentication steps, or put far more of their savings into a single non-yielding asset than their broader financial plan could actually support. The investors who tend to feel good about their decision years later are almost always the boring ones, the ones who bought modest amounts from reputable sources at fair prices, documented everything carefully, chose storage that matched their comfort level, and treated the whole thing as one deliberate piece of a much larger picture rather than a bet placed on a single number they saw scrolling across the screen. Gold in 2026 earned its moment in the spotlight, honestly, through genuine structural demand from central banks rebalancing their reserves, from households across Asia and elsewhere preserving generational wealth the way they always have, and from investors everywhere looking for something solid to hold on to during a stretch of genuine economic uncertainty. But a moment in the spotlight is not the same thing as a guarantee. And the same metal that surged past $5,500 an ounce in January had already fallen more than 20% from that peak within months. A sharp reminder that even the oldest, most trusted store of value in human history moves in both directions, sometimes quickly and sometimes painfully. Understanding that duality, the genuine long-term case alongside the very real short-term risk, is what separates informed ownership from speculation dressed up as tradition. Whatever you decide, whether that's a single 1-ounce bar tucked away as a form of financial insurance, a small position in a gold ETF for simplicity, a modest slice of a retirement account rolled into a properly structured gold IRA, or a decision that gold simply isn't the right fit for your situation this year. The goal isn't to chase the next headline number, it's to walk away from this understanding the mechanics well enough that whatever you choose is actually your own informed decision, made with clear eyes about the premiums, the storage trade-offs, the authentication risks, and the role gold realistically plays inside a diversified financial life, rather than a decision made simply because gold was trending everywhere you looked.